Welcome back, my friends. The news today is that home builder sentiment has collapsed to a 10-month low as mortgage rates soar. Builder sentiment dropped 4 points to 40 in October, and September's read was revised down 1 point. This marks the third straight monthly decline in builder confidence. 62% of builders reported offering sales incentives of all forms in October, up from 59% in September, and tied with the previous high for this cycle set in December 2022. But before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So be sure to check out ProWorldNet.com if you are looking for a job or an employee. Builder confidence in the market for single-family homes dropped to the lowest level since January, as builders contend with a market dominated by high mortgage rates and costs for financing. The monthly National Association of Home Builders Wells Fargo Housing Market Index dropped 4 points to 40 in October, and September's read was revised down 1 point. Anything below 50 is considered negative. This marks the third straight monthly decline in builder confidence. Builders point squarely to mortgage rates, which are now at a 23-year high. The average rate on the popular 30-year fixed mortgage has remained over 7% for 2 months. Affordability has fallen to near record lows. Of the index's 3 components, current sales conditions fell 4 points to 46. Sales expectations in the next 6 months dropped 5 points to 44. And buyer traffic dropped 4 points to 26. In order to get buyers in the door, builders are using more incentives again. This includes buying down mortgage interest rates. About 62% of builders reported offering sales incentives of all forms in October, up from 59% in September, and tied with the previous high for this cycle set in December 2022. In addition, 32% of builders said they cut home prices. The monthly confidence index of home builders in the U.S. fell by 4 points to 40 in October, which is the third straight drop in the index. The decline in sentiment is attributed to rising mortgage rates above 7%, which has triggered a sharp reversal in home builder sentiment. The rise in mortgage rates has led to lower levels of buyer traffic, as some buyers, particularly younger ones, are priced out of the market because of higher interest rates. Higher rates are also increasing the cost and availability of builder development and construction loans, which harms supply and contributes to lower housing affordability. The decline in builder confidence is also due to stubbornly high building material costs and declining affordability conditions that are pushing more buyers to the sidelines. Production bottlenecks, rising home building costs, and high inflation are causing many builders to halt construction as the cost of land, construction, and financing exceed a home's market value. The Federal Reserve's hawkish monetary policy has led to higher interest rates, which have increased the cost and availability of builder development and construction loans, harming supply and contributing to lower housing affordability. Mortgage rates are expected to remain elevated amid ongoing economic uncertainty and the Federal Reserve's rate-hiking war on inflation. Mortgage rates began September above 7% before reaching 7.57% in the second week of October, which is the highest rate since 2000. I expect mortgage rates to remain elevated amid ongoing economic uncertainty and the Federal Reserve's rate-hiking war on inflation. There is a relationship between Treasury yields and mortgage rates. When Treasury yields rise, investors in mortgage-backed securities demand higher rates. They want compensation for the greater risk. This leads to an increase in mortgage rates. The 10-year Treasury note affects 15-year and 30-year conventional loans. As bond prices go up, mortgage interest rates go down and vice versa. This is because mortgage lenders tie their interest rates closely to Treasury bond rates. When bond interest rates are high, the bond is less valuable on the secondary market. This causes mortgage interest rates to rise. Economic stress leads to a downward-sloping yield curve, which increases expected refinance activity, shortening mortgage durations. But what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.